If you can master reading a stock chart, you will be able to make such better trading decisions. I'm going to start off by teaching you how to identify trends, how to find support and resistance, and how to predict the direction of the market based on chart patterns. Then we're going to move into more complex analysis, understanding market flow and advanced chart patterns. And then we'll look at some tricks that you can use to take your chart analysis to the next level. When it comes to trading, you have three different types of trends that the market can be in. You have a downwards trend, a sideways trend, and an uptrend. In a downtrend, the market swings will be making lower lows and lower highs as it stair steps down. And then in a sideways trend, the market will be making highs and lows that are roughly in the same area. And then in an upwards trend, it will just be doing the opposite of a downtrend. The highs will be continuously getting higher and the lows will be continuously getting higher as well. And what we can do with these swings is we can draw support, resistance, and trend lines to predict what the market will do in the future. When we see something like this double bottom right here, we can draw a support zone off of those two touches that allow us to see where the market will bounce in the future. And we can use that to take trades off of. And on the flip side, where the market makes a double high, you can make a resistance zone off of those two touches and then see where the market will find resistance and sell off in the future. This is the basics of how you want to read a chart and trade using technical analysis. And what you can do when it comes to trends, you can use what's called a trend line or a channel to help identify when the market is going to continuously bounce and where it's going to continuously bounce, or when that trend is potentially over and the market might shift into doing a different trend. The basic way to draw a trend line or channel is just use the extreme of the swing and then the next major swing or pullback in that trend. And then from there, you will be able to just extend that channel or trend line out, and it'll tell you a lot of information on the future of what the market is doing. And so from there, with that established, as the market comes back and touches the top of the trend line later in its cycle, you can take trades off of that. And so using just basic trend lines and support and resistance, we can use technical analysis to make a lot of really powerful assumptions about what the market can do in the future. Now, a more advanced way that channels can sometimes show up is something called a spike and channel. Sometimes in the market, you will have pretty big moves up in the market, and then the market will start to find a more consistent trend. And so what you can do is you can look for that channel after an initial move up in the market, because sometimes actually drawing a channel won't make sense off of that initial extreme, but when you actually draw it off of that spike and channel idea, it'll make a lot more sense. And you can actually, if it looks cleaner, you can draw the channel off of the highs. You don't always have to draw it off of the lows or the highs, whatever works better. And here we can consistently see that the market is respecting this resistance level as it trends higher. And then it attempts to bounce off of the lows of this level, but inevitably fails. And once that happens, you can see there is a big trend shift. And so again, these are extremely important in identifying the trend. If you can just follow these, you'll be able to know what the trend is doing the majority of the time. Now let's look at a few key stock chart patterns. Now all these is a basic summary of what these certain movements in the market mean. And so if you can just understand the movement in general, you will be able to understand what every pattern means without having to study them. Now let's first look at a continuation pattern. This one is called a flag pattern. You have a bullish flag and a bearish flag. And the only difference is a bullish flag showing a potential that the market is going to continue higher, and a bear flag shows the potential that the market is going to continue lower. All it takes to see these patterns is a previous uptrend in a bear flag followed by some consolidation. And then the idea is when the market breaks this consolidation area, making us that flag, is that the market is going to continue higher. And then the same thing for the bear flag, is the market is coming down, it's sitting in a consolidation period. When the market breaks that flag, it's going to continue lower. Now, the reason why this works in terms of price action, if we look at a bear flag, is the market moves down, showing a lot of weakness, and then it starts to consolidate. And all consolidation is it's showing a balance between buyers and sellers. And the idea is, well, we're already in a downtrend, so the sellers are probably gonna continue that momentum down once this balance in the market ends. And so a great live example of that is right here. The market has made a really big sell-off all of a sudden, and then it has gone into a consolidation. Now, there was a little bit of a pullback here from the lows, and that is totally okay. Again, the main idea is still in place. The market has shown a lot of weakness or momentum to the downside, and then it has just kind of started to sit here showing that balance. And then you can see once this consolidation area is broken, the market just takes off, continuing that downtrend lower. So let's look at another pattern that really shows you the basics of how powerful reading the market can be. This is a reversal pattern that shows you when the market is going to potentially reverse from a downtrend into an uptrend. And all this is called is a head and shoulders pattern. This is what we call a bullish head and shoulders pattern. If we flip it to what would be a bearish head and shoulders pattern, it can make a little more sense where the name comes from. We have the head in the middle and then these shoulders on the side. And all this pattern really shows you is when the market is switching from making lower lows and lower highs to making higher highs and higher lows. It's just showing you that basic inflection point of switching from a downtrend to an uptrend. And we can use this to see where the market is potentially going to reverse. To show you what this looks like on an actual example, here we have a downtrend with making lower lows and lower highs, and then it starts making an uptrend of higher highs and higher lows. And so down here, when we see this higher low put in, we can use that as an entry point into betting that the market is going to reverse. And to show you a little more advanced chart reading here is you can see that the market has a very strong sell-off here initially, and then it starts to peter out when it reverses. And this is one way to see that the market is starting to bottom. Just looking at the price movement in the market, it's very, very strong initially, just red bar after red bar. We have actually a bull flag here, you can see, where once that flag was broken, the market continued lower. It didn't go that much farther, but it did continue lower for a while. So that was a good signal there. And then over time here, these pullbacks and bullish moves start to get more. And so you can see if you just kind of look at this in a big picture, it starts to make a rounded bottom shape. And so kind of just looking at it like this right here, you can see, okay, yeah, this downtrend is losing momentum, and that gives you a good reason to think it might start to end and we could start to either go up or go sideways. And so at a minimum, it shows you that the downtrend is starting to slow. Now, in terms of figuring out a target for this potential reversal off of this low area down here of this head and shoulders, the market can be very consistent with giving back an unhealthy move. This market moved very quickly down, and it wasn't able to have healthy pullbacks, making it a healthy move. And so because of that, if the market reverses off of this head and shoulders, it's likely to give this whole move back up. The reason because of this is because there wasn't that much supply and demand on the way down, making this a healthy move. And so it doesn't take that much to move the market back up in this direction. And so you can see, if we actually see where the market kind of topped out here, it was pretty much exactly where the market started to sell off from. And now when it comes to understanding the flow of the market, and what it could potentially do in the future, understanding and seeing that, hey, we had a big volatile move here, that means that the market has the potential for more volatility in the future. And so this can seem really simple, but this is really important when trying to predict what the market can do in the future. Because if you have a time in the market where the market is not showing clean volatility, you can see here, just the market's really back and forth, and there's a lot of just candlesticks on top of each other. And what this does is this is showing you that there is not that much movement in the market. And so what you want to do when you're analyzing the market is you want to look out for when the market's doing this and say, okay, hey, this is not a good area to trade. It's unlikely that I'm going to get good movement, and stay out of it, because the movement might not happen. And even if it does, it might not be that clean. Versus here, the market is a lot cleaner. The moves are a lot more directional. There are not many times where the market just has a ton of candles stacked on top of each other. It does in this little consolidation bear flag that we have right here. But because we had this volatility here, you can assume that the market still has that ability to continue that volatility. A really good rule of thumb that I like to use is the market repeats itself 80% of the time. And so if the market is having volatility and in a good downtrend, it's probably going to stay in that downtrend and keep that volatility. Or if the market is in a really tight and sloppy trend, it's probably going to stay in that tight and sloppy trend. A big trick that you can do when it comes to finding support and resistance and looking at trends is looking at multiple time frames. If you're, let's say, trading on a 1-minute chart, it is really good to look at higher time frames like a 15-minute chart to understand the bigger picture, and you can draw your support, resistance, and trend lines off of this, because trend lines and support and resistance drawn off of a higher time frame are going to be stronger because the moves in the market are more significant. For example, if we look at the S&P 500 futures here, you can see here there are some key swing highs that the market has generated. And so off of these levels, you can draw a resistance zone that you can then keep track of as the market potentially swings up into it on a smaller time frame that you're actually trading, and then get in based on what you see on a smaller time frame. And so zooming into a 1-minute chart, we can see we have created a powerful resistance zone that the market is butting into. And because of that, we can look for a reversal and bet that the market is going to go lower. Now, with some of these patterns we have learned, what you can do and the best way to trade is couple all of these things together. We have a resistance zone, and now we want to look for something like a pattern. We want to look for a head and shoulders in the market to see that the market is starting to reverse, or a bear flag here as well, like we looked at earlier, to help show that the market is going to continue or start moving lower. And so this is a really great example of taking all these patterns and using them to help predict what the market is going to do. And so this head and shoulders right here is showing us a clean reversal, and then this bear flag shows us a continuation of that reversal. And from there, the market just starts to crater lower, and that movement is because we took this level off of a larger time frame. Going back to the 15-minute chart, because we have this larger resistance level, the market can have really big moves off of those because we're looking at larger, bigger picture trends in the market. So let me show you what this looks like in a real trade. What we're looking at here is the S&P 500 futures on a 1-minute chart. This is what I like to trade. And all I've done here is I have done exactly what we just talked about. There is a resistance level up here drawn off of a 15-minute chart. And then I have just watched the market on a 1-minute chart and looked for the market to make a very strong climactic move that was unhealthy. And then it started to slow down. It started to find some resistance up here. And then all of a sudden it started to make lower lows and lower highs. And so all I did was just use that understanding of being at a resistance area it making lower lows that signifies a downtrend. And then I jumped in right here, betting that the market is going to go lower. And like what we talked about before, a good target for this would be down here, because this is where the market initially took off. And so if it's going to give that back up, well, that is a really good target to look for. And what this allows me to do is risk a smaller amount to get a higher reward. And so in trading, I don't have to be right very often when doing this. And this is very beneficial for being a profitable trader, because having to be right all the time or more often is very hard when it comes to trading. Now, if you want to go way more into the strategy, check out this video right here. I've gone into way more detail and discussion about my actual strategy that we just talked about.